The US stock market, gold, and Bitcoin have repeatedly hit new highs this year. After Trump's election, the market set new records once again. Meanwhile, the Federal Reserve's second interest rate cut has pushed this market frenzy even higher. How long can this market boom last? And what does the future hold? Today, let's take a look at the cold, hard facts. Behind this market surge is nearly $36 trillion of US national debt and massive interest payments. With the debt increasing by $1 billion every single day, the government is recklessly increasing spending and using deficit spending to stimulate the economy. During Trump's second term, this debt strategy will be further amplified. All of this will significantly push up inflation in the near future. The market will also rise in the short to medium term. Remember the Great Depression of the 1930s? I call this current market craze the Great Financial Surge. And we all know what follows after a market frenzy. In this episode, we'll start with the US debt problem, understand the causes of the Great Financial Surge, why the US government wants inflation to rise, and the impact of Trump's policies on the market. Most importantly, we'll discuss how ordinary people like us can avoid being left behind and losing money in this roller coaster ride. The S&P 500 has risen by 26% this year. On the day after the election, it rose by 3.8%. Tesla jumped 14.2%. No matter what platform you're on, the news is almost unanimously bullish on the market. If you pay close attention, you'll find that more and more people don't want to miss out on the money-making opportunity of a rising market. Investors are flocking to the market, not because the fundamentals of the market have improved, but because expectations for the future have improved. Market sentiment is super optimistic. This sentiment is constantly rising, and all of this suggests that we may soon be at a stage high. After the high, what awaits investors is a sharp market correction. The stock market is surging higher. Even janitors are talking about investing. This is the Great Financial Surge. There are already many similar signs of a surge among retail investors. At the same time, veteran investors are showing opposite signs. Like Warren Buffett, who started selling stocks 12 months ago, cutting his Apple stock holdings in half. Another big short investor, Michael Burry, also sold half of his holdings. While we don't know when this roller coaster will reach its peak, it's certain that more and more people are joining the ride, pushing it towards the top. To understand the current market, you must understand history. In the past 100 years, there have been several major financial surges, each with different causes, but the same result: a market crash. I've picked out 3 of the most representative surges to review with you. The 1929 market surge is the most famous in history, bar none. This bubble was a pivotal event in American financial history. In just a few short years, investor optimism and rising company valuations pushed the stock market to its peak, but the eventual crash triggered a global economic depression. During the Roaring Twenties, the US economy developed rapidly, with industrial productivity and consumption levels continuously rising. The rapid rise of industries such as automobiles, home appliances, and movies made the United States the center of global industrial production. Financial institutions, of course, wanted a piece of the pie, and they used the boom to stimulate the stock market through massive credit. Businesses and individuals, with the help of banks, used leverage to buy stocks. The frenzied confidence in stocks gradually spread. The media and financial analysts called the stock market at the time a golden age, further attracting a large number of new investors. From 1924 to 1929, the S&P 500 and Dow Jones Industrial Average rose year after year, with the Dow climbing from 100 to 381 points. More and more ordinary people put their life savings into the stock market, even selling all their assets to enter the market, just wanting to get rich overnight. Retail investors and small businessmen, people who knew nothing about stocks, poured in, accelerating the market's rise. To get higher returns, many investors used leverage to buy stocks, further fueling the bubble's expansion. By 1929, the vast majority of stock trades were leveraged. The market surge had reached its peak. Once the market experienced slight fluctuations, it could lead to massive liquidations. On October 24, 1929, Black Thursday, the stock market began to sell off. Investors panicked, and in the following days, stocks were subject to massive and continuous selling. October 28 and 29, Black Monday and Black Tuesday, saw the Dow Jones Industrial Average fall by nearly 13% and 12% respectively in just 2 days, marking a rapid collapse of the stock market. The crisis quickly spread globally, leading to the collapse of hundreds of banks and the unemployment of millions. Businesses closed due to lack of funds. Production was drastically reduced. Demand fell, prices fell, and the economy entered a vicious cycle. The ensuing Great Depression lasted for more than a decade, and the US stock market did not return to its 1929 level until 1954. This great surge and the subsequent market crash not only affected the lives of millions, but also plunged the global economy into a decade-long downturn. Japan in the 1980s also experienced a major market surge before its crash. After World War II, the Japanese economy recovered rapidly. In the 1970s and 1980s, Japanese industry, especially in the automotive and electronics sectors, made tremendous progress, gradually becoming the engine of the global economy. To stimulate economic growth, the Japanese government adopted low interest rates and a loose monetary policy. Bank lending rates fell, and a large amount of cheap money flowed into the market. Low interest rate policies encouraged businesses and individuals to borrow money for investment, leading to a rapid expansion of the stock and real estate markets. As asset prices continued to rise, market sentiment became extremely optimistic, and more investors and speculators poured into the market, further driving up stock and real estate prices. During this period, stocks and land were seen as investment tools for preserving and increasing value. Land prices in cities like Tokyo skyrocketed. Due to limited land resources, land prices in some areas even reached millions of dollars per square meter. From 1985 to 1989, the Nikkei index soared from about 13,000 points to nearly 39,000 points, almost tripling. In this optimistic market atmosphere, individuals and businesses used a large amount of bank loans for investment, and leverage ratios soared. Many large companies even mortgaged their own stock and real estate assets for financing, exacerbating the liquidity of funds in the market. The ever-expanding asset prices created a general sense of affluence in Japanese society, and consumption levels and quality of life improved significantly. Blind optimism about the economic outlook further fueled the formation of the asset bubble. This great surge had reached its final edge. In 1990, the Bank of Japan began to tighten monetary policy, raising interest rates to curb inflation and cool the rapidly expanding economy. The interest rate hike triggered market panic, and a large number of investors began to sell off stocks and real estate, leading to a rapid market decline. The Nikkei index fell by more than 30% in 1990. In the following years, both the stock market and the real estate market continued to decline. The bursting of the bubble plunged the Japanese economy into a recession that lasted for more than a decade. Many banks faced the risk of bankruptcy due to a surge in bad loans. Japan's economic growth rate slowed sharply, and this period was called the Lost Decade. Later, this term became the Lost 2 Decades and the Lost 3 Decades, which shows the profound impact. The cause of both of these surges was high leverage, that is, a debt explosion, where a massive amount of private credit funds entered the market, creating a bubble. It can be said that the uncontrolled financial operations of the private sector caused the great financial surge. The tech stock surge of 2021 and the great financial surge of 2025 were also caused by loans. However, the borrowers shifted from banks, businesses, and individuals to the US government. We are all familiar with the 2021 US tech stock surge. During the pandemic, the US government implemented large-scale fiscal stimulus and loose monetary policy, which led to a rapid rise in tech stocks. This round of tech stock surge was mainly concentrated in large technology companies such as Apple, Amazon, Microsoft, and Google. However, emerging technology companies and startups also received a high degree of attention from investors. To cope with the economic impact of the pandemic, the Federal Reserve lowered interest rates to historical lows and purchased assets on a large scale, which made financing costs extremely low. Businesses and individual investors had ample funds flowing into the stock market. The US government, through multiple rounds of fiscal stimulus packages, issued government bonds, increased the fiscal deficit, and distributed a large number of relief funds to individuals and businesses. These funds not only met basic consumption needs, but were also used by some investors for investment, especially in the stock market. The pandemic led to a surge in demand for services such as working from home, online shopping, entertainment, and streaming media. As a result, the performance of technology companies increased significantly. This made the technology industry's prospects look good and attracted more investors. Investors believed that the technology industry would lead future economic growth, which, coupled with the low interest rate environment after the pandemic, formed a highly optimistic sentiment towards technology stocks. From the beginning of 2020 to the end of 2021, the Nasdaq index rose by nearly 100% in less than 2 years. The market value of large technology stocks repeatedly hit new highs. For example, the market value of Apple and Microsoft once exceeded $2 trillion. A large number of retail investors poured into the market through low-cost online trading platforms, especially in technology stocks and technology-related ETFs, establishing a large number of positions. This exacerbated the market's optimistic sentiment. As the US economy gradually recovered, inflation began to rise. At the end of 2021, the Federal Reserve began to hint that it would raise interest rates and reduce asset purchases in the future. Investors expected liquidity to tighten, which led to some funds withdrawing from overvalued technology stocks. At the beginning of 2022, the Nasdaq and technology stocks experienced a sharp decline, especially high-valued growth technology companies. The market value of some technology stocks evaporated by hundreds of billions of dollars. The reassessment of future growth and profitability caused the technology stock bubble to gradually burst. After this round of technology stock surge, the US stock market became more cautious about high-risk investments. The market reassessed the earnings expectations of technology companies, and this process prompted investors to pay more attention to company fundamentals, especially profitability and cash flow, prompting the market to gradually return to rationality. Our current market has also entered the early stages of a great financial surge. The reasons for its formation this time are different from each previous time, including the existing massive government debt, the expected significant increase in government debt after Trump takes office, and what the US government must do to keep the borrowing game going, create a crisis. Over the past century, the US federal government's debt has increased year after year. After the 2008 subprime mortgage crisis, in order to stimulate economic recovery, the debt climbed sharply. During the pandemic, the approach of prescribing the right medicine for the right ailment further aggravated the debt problem. Just like us ordinary people, the government has to pay interest when it borrows money. This debt could still be controlled when interest rates were relatively low. The reason why the large-scale borrowing after the pandemic could be sustained was that the Federal Reserve lowered interest rates to zero at that time. However, low interest rates stimulated economic recovery while increasing unemployment and inflation. But when inflation is too high, the Federal Reserve has to raise interest rates to suppress it. For example, if your house is worth $1 million and you have a loan of $800,000 at an interest rate of 2%, then you have to pay $16,000 in interest every year. If the interest rate suddenly rises to 7%, the annual interest payment will be $65,000. Ordinary people simply can't afford to pay so much more. Now, the US national debt is about to reach $36 trillion. In the context of rising interest rates, the US government's annual interest expenditure has exceeded $1 trillion, even higher than the national defense budget of about $900 billion and medical insurance and healthcare expenditures. The government's continued overspending has accelerated the rate of debt growth. The fiscal deficit data for 2024 shows that this level of interest expenditure is unsustainable in a high interest rate environment. This is one of the reasons why the Federal Reserve was forced to cut interest rates. Although GDP is growing at an annualized rate of 3%, the unemployment rate is also at a low of 4.1%. Judging from the economic data, everything seems to be fine. However, the Federal Reserve is still cutting interest rates, which shows that the US government has no way to bear higher interest rates. At its last meeting, the Federal Reserve cut interest rates by 0.5 percentage points and cut them by another 0.25 percentage points 2 days ago. Despite the strong economy and job market, The benchmark interest rate is still falling and is expected to fall to 3% by the end of 2026. However, an interest rate of 3% is still not enough to support the current huge debt. What may happen in the future is that the Federal Reserve will create a crisis and use the crisis as an excuse to drastically cut interest rates to close to 0% and use the low interest rate environment for debt refinancing. Just like car loans and mortgages have different terms, government bonds are also divided into short-term, medium-term, and long-term. Currently, the Federal Reserve's benchmark interest rate is 4.5% to 4.75%, and the interest rate on newly issued bonds is still too high. If these bonds mature and are refinanced, the interest expense will still be unaffordable, especially for the medium-term government bonds issued 2 to 10 years ago, when interest rates were very low, and the cost of refinancing when they mature is now soaring. In order to reduce debt pressure, the Federal Reserve must quickly cut interest rates, and a target of 3% cannot solve the problem. The government has learned from past experience and has begun to manipulate debt. In a future crisis, when interest rates fall back to 0%, the government may issue more 20-year and 30-year government bonds to lock in long-term low interest rates. Similar situations have occurred after the 2008 crisis and the most recent crisis. The government took advantage of low interest rates to issue a large number of long-term bonds, but avoided long-term high interest rates when interest rates rose. If there is another crisis, it is not only possible to suspend the debt ceiling and increase borrowing, but even to issue 50-year government bonds. China is already doing this. We are now sprinting down the road of this great financial surge, and the faster we run, the faster it gets. After Trump takes office, he will impose a 60% tariff on all Chinese goods, a 20% tariff on all other countries, expel 1.1 million illegal immigrants, and cut corporate taxes to 15%. It is predicted that after Trump takes office, the US national debt level will increase by at most $15 trillion. It can be said that the US economic development will be based on borrowing money. At the same time, foreign governments and investors are bearish on US Treasury bonds. So these bonds have to be sold to Americans, US institutions, and the Federal Reserve. By then, the US dollar as a reserve asset will further depreciate. Who will buy these debts? Most likely, the Federal Reserve will print money out of thin air, which will lead to serious inflation. In the past few years, we have experienced rising asset prices, soaring housing prices, stock markets, gold, silver, medical care, and daily necessities. The current great financial surge could lead to hyperinflation, ultimately leading to a great reset. If you are already invested in the market, you must be particularly excited about the market's performance this year, especially in recent days. Are you making money? However, investment magnates like Warren Buffett and Michael Burry have been withdrawing from the market one after another since 6 to 12 months ago, indicating that they have seen risks that we ordinary people cannot see. In the face of such risks, what should we ordinary people do? We are still in the early stages of the great financial surge, which means there is still room for the market to rise. In the long run, inflation will return and may remain at a relatively high level for a period of time, which means that the money in your hands will depreciate and purchasing power will decline. Under Trump's rule, the gap between rich and poor is bound to widen. If we want to preserve our wealth and not be left behind by the market, we must first find a way to preserve the value of our money. If you are still renting a house, you can consider buying a house. A house is also called real estate, and its volatility is inherently small. In the long run, even if it does not perform well in investment, it will at least not shrink your wealth. However, under the premise of future currency devaluation and inflation, your rent will rise sharply. Relatively speaking, the pressure of mortgage repayments after buying a house will become smaller and smaller under the same market conditions, because inflation will dilute the actual value of the loan. In other words, buying a house is better than renting in most cases. Here I want to emphasize that the real estate market in each country, and even in different regions of the same country, has its own independent attributes. The real estate investment logic applicable to the United States is not applicable to Australia nor to Taiwan. Everyone should analyze it independently according to the country they are in. In terms of value preservation, you can also try to invest in precious metals such as gold and silver, ETFs of the S&P 500, and hold them for a long time. These are all very good choices. Buying these assets can basically guarantee that you will not be left behind by the market in the future. If you want to make more money, in addition to preserving value, then you must take some risks, select stocks, find a few high-quality stocks, and hold them for a long time, or trade them. Of course, this stock selection and trading is not something that our channel can help you with. I personally think that anyone who teaches people to choose stocks in the media is 9 times out of 10 a liar. The remaining 1 or 2 may make some money after operating, but it is only limited to a certain period of time. Someone around you may say that they bought Tesla 5 years ago and have now made 9 times their money. Did they tell you about other investments that lost money? I know a European fund manager who was showing off in his WeChat moments, posting several pictures saying that he recommended his high net worth clients to buy a fund which has risen by 19% in the past 12 months. And he was celebrating. This is still the return before deducting fund management fees and wealth advisory fees. I thought to myself that you can earn 26% by buying the S&P 500 directly. And you can use an IB account for free, so what do you need a fund manager for? The market tells us that there is almost no fund manager who can beat the market for 10 consecutive years, which has been verified in Warren Buffett's bet. I don't think self-media people can do what professional fund managers can't do. Therefore, our channel never does stock selection and analysis, but focuses on financial quotient and economic knowledge interpretation. When I was writing the script for this video, I was guessing that someone would definitely say that our channel is bearish again. In fact, being bullish or bearish is just a personal opinion and not the point. The point is that each of us wants to make money. In my own investment philosophy, the length of time in the market is far more important than timing the market. So whether I am bullish or bearish, most of my funds will be used for long-term, continuous investment in the market. If you haven't started investing yet, now is the time to put down what you're doing and start learning. If you've watched this far and found the video helpful, don't forget to subscribe to the channel and give me a thumbs up. This is Michael's Fortune Bread, sharing financial knowledge that you can't learn in school. I'm Michael, and I'll see you in the next video. Bye. The US government debt has been a topic of intense debate for decades. With the national debt exceeding $30 trillion, many wonder how it will impact future generations. The debt is primarily driven by government spending on programs such as Social Security, Medicare, and defense. While some argue that the debt is manageable, others fear it could lead to economic instability. Looking ahead, market analysts predict a mixed outlook for the economy. Some sectors, like technology and healthcare, are expected to continue their growth trajectory. However, there are concerns about inflation and potential interest rate hikes, which could affect consumer spending and investment. It's crucial to stay informed and adapt to the. When it comes to investment strategies, diversification remains key. By spreading investments across various asset classes, investors can mitigate risks and enhance potential returns. Additionally, considering long-term goals and risk tolerance is essential for building a robust portfolio. Remember, the market can be unpredictable, but a well-thought-out strategy can help navigate the ups and downs. In conclusion, understanding the complexities of government debt, market predictions, and investment strategies is vital for making informed financial decisions. Staying educated and proactive can help secure a stable financial future. Thank you for joining us, and we hope this information has been valuable to you.